Welcome. This is Babu Dinesa Babu, and I'm presenting the evolution of the US monetary system. Throughout this presentation, I'll walk you through key inflection points from the Bretton Woods Agreement to the collapse of the gold standard and the age of modern fiat currency. We'll explore how decades of emergency intervention and artificially low borrowing costs have reshaped the financial system in radical and often irreversible ways. What began as a system grounded in discipline has become one that's sustained by credit and increasingly aggressive policy, a structure that might appear stable on the surface but rests on deeply fragile foundations. In the aftermath of World War II, much of the industrialized world laid in ruins. Europe and Japan were devastated, the Soviet Union was isolated, and the United States stood alone as the dominant global power. With over half the world's GDP and the vast majority of gold reserves, to rebuild the global economy, the US led the creation of a new monetary order, the Bretton Woods system, which was established in 1944. Under the system, the US dollar became the anchor of the global economy. Other currencies were pegged to the dollar, and the dollar itself was backed by gold at a fixed rate of $35 an ounce. This arrangement, part gold, part dollar, created a stable foundation for decades of post-war growth and international trade. It marked the beginning of the dollar's reign as the world's reserve currency. However, after decades of increased government spending and government mismanagement, the Bretton Woods system started to collapse. Over the next few slides, I'll explain how the system started to unravel. In the 1960s, the United States was spending aggressively. From the Vietnam War to domestic spending programs such as the War on Poverty, Medicare, Medicaid, welfare, the government was spending a lot more money than it actually had in gold reserves to back up its currency. And the rest of the world began to lose confidence in the ability for the US to exchange gold for its dollars. In one particularly striking incident, France sent a warship to New York to physically retrieve its gold, a clear signal that trust in the system was breaking down. And if other countries followed suit, demanding gold in exchange for dollars, this would put unprecedented pressure on the US gold reserve. By 1971, the pressure became too great. Our gold reserves were rapidly shrinking as foreign nations lined up to convert dollars for gold. And President Nixon then shocked the world by announcing that the US would suspend the convertibility of dollars into gold. This moment, known as closing the gold window, ended the Bretton Woods system. From this point forward, the US dollar was no longer backed by anything tangible, and it became a pure fiat currency. Most people didn't realize at the time, but this single policy shift would reshape the global economy. It gave governments and central banks the ability to print unlimited money, and it set in motion a new era, one that was defined by inflation, debt expansion, financial bubbles, and the steady erosion of purchasing power. After Nixon closed the gold window in 1971, the world entered a new era. Countries quickly abandoned fixed exchange rates and moved toward floating currencies. This gave governments more flexibility, but also more room to print and borrow and inflate the currency. In the 1970s in America, things quickly spiraled into a period of stagflation, which means high inflation with very weak growth. And this was in part due to oil shocks that we had when we had an oil embargo from Middle Eastern countries. But it's also due to our deficit spending, our loose monetary policy, and all the currency we printed in the 60s. By the end of the decade, inflation had reached double digits, and confidence in the dollar was again at severe risk. So in response, the Federal Reserve Chair, Paul Volcker, made a bold move. He raised interest rates above 20%, a painful but necessary shock that finally broke inflation. It came at the cost of a deep recession, but it saved the dollar and it restored credibility to the US financial system. So on the left, we see inflation, which is relatively low in the 1960s, but suddenly surged to double digits during the 1970s. Due to the oil shocks of 1973 and 1979, combined with easy money and runaway spending, this pushed inflation to as high as 14% by 1980. Now on the right, we see how the Federal Reserve responded to this. Under Chairman Paul Volcker, the Fed raised rates aggressively, pushing the federal funds rate above 20% by 1981. This was a drastic move, and these high rates caused a severe recession, but eventually it finally broke inflation. Paul Volcker's actions restored faith in the US dollar, and it signaled that the Fed was serious about maintaining price stability, even with great short-term pain. With inflation finally tamed, the US entered a new phase, one that was defined by easy credit, low interest rates, and growing financial innovation. The confidence was high, the debt was cheap, and risk-taking accelerated. Over the next few slides, we'll explore how this era reshaped the global economy by fueling asset bubbles, widening imbalances, and setting the stage for repeated crises. By the 1980s and 1990s, inflation was finally brought under control, and then interest rates became more flexible under Alan Greenspan. And this easy access to credit fueled strong economic and market growth. In the 1990s, the tech boom and globalization drove investor optimism. Risk-taking soared as capital became more accessible, setting the stage for the dot-com bubble. From 1995 to 2000, tech stocks exploded. Even unprofitable startups attracted massive investment. By 2002, this became a massive bubble, and then the Nasdaq crashed nearly 80%, wiping out trillions in market value. In response, the Fed aggressively cut rates from 2000 to 2003, dropping rates from 6.5 down to 1%. And this encouraged more borrowing, but it also contributed to more risk-taking and more instability. So, to help illustrate what happened, please take a moment and look at these graphs. They tell a powerful story of not just the market movements, but of cause and effect. So, on the left, we see the Nasdaq during the dot-com bubble. From the mid-1990s to 2000, tech stocks surged over 500%, driven by speculation and easy venture capital. But then the bubble burst, and the Nasdaq crashed nearly 80% by 2002, wiping out trillions from the market. Now, in the middle, we see how the Fed responded. To cushion the blow of the crash, the Fed slashed interest rates from about 6.5% to down to 1% by 2003, the lowest levels in modern history. And then on the right, we see the effects of that. So in the 1990s, with the relatively higher rates, many people were out of the housing market. But now with cheap credit and very low rates, there was a flood of demand, and housing prices started to quickly accelerate. Fueled by cheap borrowing and the flood of credit, real estate started to turn into a boom. but then it started to spiral into a full-blown bubble. So the main takeaway is that when trying to clean up one bubble, policymakers using low rates and manipulating rates might have fueled the next bubble. So to further explain, in the early 2000s, the Federal Reserve slashed interest rates to 1% to respond to the dot-com crash. And this introduction of cheap credit fueled a surge in borrowing, and housing in particular was seen as a sure bet. And it started to look like we were on the road to an economic recovery. But behind the scenes, the financial system was becoming more fragile. The rise of mortgage-backed securities and complex derivatives like CDOs meant that risky subprime loans were being bundled and sold across the world. And lenders prioritized volume over quality. Rating agencies gave high grades to toxic assets, and the entire system became dependent on ever-rising home prices. Then in 2008, it all came crashing down. Lehman Brothers collapsed, triggering a global panic. Credit markets froze, trust evaporated, and the result was a massive global recession, with soaring unemployment and a wave of bailouts. In the aftermath, central banks became more active than ever before, launching unprecedented interventions that would define a new era of monetary policy. In response to the 2008 crisis, the Federal Reserve began a new experiment, quantitative easing, which is essentially money printing. By massively expanding its balance sheet and purchasing government and mortgage-backed securities, the Fed injected trillions into the financial system, essentially creating new money to stabilize markets. Alongside this, the Fed kept interest rates near zero for years, a policy known as ZIRP, the zero interest rate policy. These actions propped up asset prices across the board, from stocks to real estate, even while the broader economy remained weak. This era marked a turning point. Markets became increasingly disconnected from real-world fundamentals, driven more by central bank policy than by the underlying economic strengths. Now, we were already on a bad path, but the COVID-19 pandemic took our policies from bad to extreme. In response to the pandemic, the US government launched the largest peacetime stimulus in history. Stimulus checks, PPP loans, and expanded benefits injected trillions into the economy with little regard for deficits or long-term consequences. At the same time, supply chains broke while demand surged, leading to the highest inflation rates in decades. Eventually, inflation started to spiral, and central banks reversed course, launching aggressive rate hikes to cool the economy. But this abrupt tightening raised new fears of economic slowdown, financial instability, and a painful adjustment to the excesses of the QE era. On the left, we see the growth of the Federal Reserve balance sheet from 2008 to 2025, a clear visual of essentially money printing. In 2008, the Fed launched quantitative easing, buying financial assets with newly created dollars to inject liquidity into the system. Then in 2012, we started to taper, an early attempt to slow the pace of this money creation, but in 2020, everything changed. Faced with the COVID crisis, the Fed unleashed massive new rounds of QE, printing trillions to stabilize markets and support government spending. By 2022, the Fed started to reverse course, attempting quantitative tightening and raising rates, but by then, the system had already become addicted to cheap, abundant money. Now on the right, we see how this ties to the growth of the US national debt. Starting in 2001, after the Bush tax cuts, the debt began to rise. And this was further accelerated by the wars in Iraq and Afghanistan, which added trillions to the debt in long-term cost. Then you got the 2008 bailouts, which added trillions more, and then the debt truly exploded in 2020 when the government deployed unprecedented levels of financial stimulus in response to COVID. Now, by 2023, because of the rising interest rates, our debt servicing costs start to truly spike, which is creating a feedback loop in which now the US government has to borrow more and more money just to pay the interest in all the debt we accumulated. We now find ourselves at a critical juncture. The US national debt surpassed 36 trillion and global debt is at historic highs. Now, much of this debt was accumulated in previous low interest rate environments, but now as interest rates rise, the system is becoming increasingly fragile. And at the same time, political dysfunction is rising, not just in the US, but in major economies all over the world. The risk of defaults is growing and investor confidence is weakening, and governments are starting to monetize their debt, which is basically printing money just to pay off their debt. And this carries a major risk of currency debasement and inflation, which further erodes public trust in both financial and political institutions. Rising polarization and global instability makes coordinated responses harder to achieve, even as the need for them become more urgent. Adding to this pressure, interest payments on US debt have now surpassed defense spending. And this creates a fiscal trap where debt servicing crowds out other national priorities. Now, escaping this trap won't be easy. It may require difficult choices, painful cuts, and drastic policy changes, all in an environment that's becoming more volatile by the day. To further illustrate this, the debt to GDP ratio is one of the most critical measures of a nation's financial health. It shows how much money a country owes relative to the size of its economy and how sustainable the debt truly is. Now, for most of modern history, the US maintained a relatively stable ratio and it hovered around 60% by 2008. But then everything began to change. With the massive bailouts, stimulus, and of course the 2020 pandemic, this has taken our debt to GDP ratio to unsustainable limits, now surging past 120%. Now on the right, you see a table of several countries that's crossed similar thresholds and the consequences that followed. Now, this table is just a list of a few examples, but there's many other countries that are not on this list, but the pattern is clear. No major economy has sustained a debt to GDP above 120% without experiencing serious consequences, whether it's currency collapse, hyperinflation, sovereign default, or decades of stagnation. Now the US is standing at the same threshold that has crippled many other nations. In the face of this rising debt and declining trust and global uncertainty, the world is quietly returning to a timeless asset, gold. Gold has recently surged from less than $2,000 an ounce in 2023, well past $3,000 an ounce in early 2025, moving sharply in response to the global instability and growing demand for real assets. Throughout history, gold has preserved purchasing power, especially in times of crisis, inflation, and monetary debasement. And unlike bonds and fiat currency, which relies on promises and trust, it carries no counterparty risk. Today, gold is playing a growing role in de-dollarization and preparations for a potential monetary reset. The strongest signal may be this: central banks, the very institutions responsible for fiat currency, have become the largest net buyers of gold in modern history. When the world's most powerful monetary authorities start shifting to gold, that's not just a hedge, that's a message to the world. The US dollar remains dominant, but its unchallenged status is now fading. Since 2001, the dollar's share of global reserves dropped from over 70% to 58%. At the same time, BRICS nations are increasing settlements in local currencies, especially in energy deals and bilateral partnerships. The dollar's weaponization through sanctions and financial restrictions has only accelerated these shifts. In response, countries like Russia and China have ramped up gold reserves, and over 130 countries are now exploring central bank digital currencies, many as an alternative to the SWIFT system and the dollar dependence. Meanwhile, the US faces a death spiral. Interest payments now surpassed $1.1 trillion per year, exceeding defense spending. The government is now borrowing just to pay interest, and that loop is tightening fast. The signal is clear: the dollar is no longer untouchable. So this slide serves as a strategic playbook on how you could best navigate the uncertainty. So first and foremost, stay liquid. Have short-term treasuries and cash so it gives you flexibility and the ability to be nimble in a very uncertain environment. Also, consider paying down high-interest debt such as credit cards and variable loans so you're not exposed to higher interest rates. Also, consider diversifying into resilient assets, things such as commodities, buying gold, buying silver, and maybe even things such as Bitcoin as a hedge against fiat currency issues. And most importantly, develop resilience. Start thinking about your network of trust, about geographic diversification, and about ways that you could be resilient and adaptable in a very uncertain environment. The dollar's dominance is not inevitable. It's a privilege. History has shown reserve currencies fall when deficits grow too large, trust fades, and alternatives begin to rise. The question isn't if the system evolves, but how we adapt. There are three pillars for the future. Reform. We either address our structural debt and deficits, or we face a crisis-driven reset. We diversify. We embrace monetary competition, whether it's new forms of the gold standard or multipolar trade systems. Or we innovate. Leadership in digital finance, from Bitcoin to stablecoins, to help retain global influence. Bretton Woods was originally built on US strength, but the next system will be built on today's vulnerabilities. Thank you for listening to our presentation. We hope that you found this presentation informative and interesting, and we look forward to engaging with you throughout our program.